When you have stocks that are trading at like, 50 to 100 times whatever they're bringing in, I don't know how to trade Solana because it doesn't make any revenue. It's like, well, dude, your company is also trading at a ridiculous valuation that doesn't make any sense whatsoever. Bitcoin was created by either a person or a group of people that needed to move money outside of the financial system for whatever reason. It could have been criminals, it could have been governments, it could have been intelligence agencies. Bitcoin trades mostly against USDT. Tether is one of the largest buyers of Bitcoin, and as of late last year, according to Tether CEO Paulo Arduino, Tether is also the largest miner of Bitcoin by hash rate. Does that look like a safe haven, or does that look like a risk asset? That looks pretty damn risky to me.
Today, I'm joined by Dan Krupka, former head of research at the Coin Bureau. In this episode, we tackle the hard questions. Is price discovery in new tokens real or just a coordinated illusion built on worse trading and influencer campaigns? Is Michael Saylor building a genuine financial innovation or a leverage structure that only works as long as Bitcoin never stops rising? And when ETF-driven custody and CME futures dominate volume, at what point does Bitcoin stop being price discovered on-chain and start being priced entirely by TradFi? We're covering all that and more. These are the questions most researchers in the space avoid entirely, but we do not. Dan, welcome to the show.
Thanks so much, Nasib. It's great to be here.
So let's begin. Let's begin with your background, right? How did your crypto story has begun? And yeah, how's it going?
Yeah, thanks, man. I'll try and keep it as short as I can. So, you could say I've been dabbling in crypto since 2018. In 2018, I bought a Litecoin because I kind of fell for that narrative, that like Bitcoin is the gold, and then Litecoin was always the silver. At least that's how it was originally pitched, right? Bitcoin is gold, Litecoin is silver. So I bought I bought Litecoin in 2018, and I'm actually from Canada, so I did that using an exchange called Quadriga CX. And anyone who's been around in crypto long enough or is from North America will know that Quadriga CX was a crypto exchange that actually went under. The founder, basically, it looks like the founder basically ran away to India, faked his own death, and there's like a whole documentary about it. And he ran away with all the money. Officially, he's dead, but they've been trying to like the authorities or someone has been trying to like dig up the body, like some lawyers or whatever, and trying to dig up the body to prove that it's actually him. And someone keeps blocking it, which is really interesting. So he's probably alive and with all the money. Anyway, so I lost all my Litecoin in that was in early 2019. And then in late 2019, I started getting back into crypto again, started doing a lot of research. I basically researched the top 500 cryptocurrencies by market cap. And what happened is around I think it was early 2020, I kind of started working in the crypto industry. I started working for a small cryptocurrency startup focused on sentiment analysis. And this was actually really promising. It was called Crypto Mood, and they were basically developing like various indicators using AI and natural language processing. This is before AI was all in the news and everything, and they were basically analyzing social media and news articles to create indicators to basically get a sense of what people were saying about crypto projects, and then trading based on that information. And it was looking very promising, but unfortunately, there was an issue with the investors, and that startup basically went under. But before that happened, I was basically, as part of working for that startup, I was reaching out to all these different YouTube channels and different influencers and platforms to try and promote our product, which even to this day, I truly believe it would have been very successful. But unfortunately, it kind of like fell through. But and one of the YouTube channels I reached out to, of course, was the Coin Bureau. And back then, I think they only had around 15,000 subscribers. I saw on their website that they were hiring, so I put in my application, and the rest is history. I basically helped grow the Coin Bureau from whatever it was, from when it was very small, helping grow, especially the YouTube channel, up to close to 3 million subscribers. So I was working behind the scenes there basically for 6 years, making that happen. Yeah.
Look, for this interview, I've prepared a set of questions that are basically the most pressing ones, right? When it comes to the crypto industry. So let's begin with insiders. If insiders are already planning their exit before you even hear about the project, are you ever actually early in crypto?
That's a great question, and I think it really depends on which crypto project you're talking about. And it seems to change like from cycle to cycle. Obviously, granted, since I've only been around since 2018, I didn't like fully see the 2017 cycle. But one thing that a lot of people understand today is that if you want to have a successful crypto project, you need to have one where people are incentivized to buy and hold. And the only way that you get that is if you kind of make it possible for people to get in early. And that's kind of, you could argue that that's kind of what we saw at the beginning of 2020 and 2021, where all these cryptos that were launched, back in 2017, 2018, a lot of those, or at least the ones that were still good, if you bought, let's say, in early 2020 sometime, as I was fortunate enough to do, then you basically were able to get in early on many crypto projects, and were able to make a decent profit, even with all these insiders that were selling, because you kind of had, those insiders, obviously, when they bought those, when they launched those ICOs, then obviously a lot of insiders probably sold initially. But then there was, that period where you have like you see it in every token, right? When the token launches, it starts at a high valuation, crashes basically like to nothing, then it's like chopping, at the bottom. And of course, that's if you believe in the crypto project, then not financial advice, but that's typically the time that you want to accumulate is when it launched, then it went basically to nothing. Everyone forgets that it exists. And then that's kind of what I did again at the end of 2019, early 2020, looking through all these crypto projects. And I found, from the top 500, I found about a dozen that looked interesting. And I was able to, quote unquote, get in early, personally. But as you're saying, Nasib, yeah, it really depends on the crypto project. It depends on where you are in the crypto project's life cycle. If it's something that just launched and you're buying up here when all the insiders still haven't, gotten their unlocks, then you're probably going to get screwed. But if it's a crypto project that's been around for a couple of years, has a pretty solid product, they have, the CEO still there. People keep, especially if you see a crypto project, for example, that continues to get post ICO funding. I think that's a very big sign that it's something that investors believe in, because it's very rare actually that you see investors come back and continue investing in a crypto project, even after the token price has fallen. And typically they do that because they believe that there's at least going to be enough hype for that crypto price to start going up in the future. So yeah, hope that answers your question. It's an
Yeah.
interesting one. Yeah.
And when wash trading, influencer campaigns, and market makers all work together to simulate demand, is price discovery in new tokens still real or just a coordinated illusion? I know that it really depends on the project, but
Yes.
it has been, it feels like a lot of the projects that we still have in the market are just surviving just because of that.
Yeah. So again, having kind of worked behind the scenes, I guess you could say like an influencer type of operation, I would say that it's not even if it's price or just a coordinated illusion. To be honest, a lot of it is manipulation, but not in the sense that you would necessarily think. From what I've seen, at least personally, is what you typically see is that you will basically have, I don't know, like a whale or market maker, whatever you want to. Usually, crypto whale or market maker, they'll come in, they'll buy a token, they'll pump up the price, and typically that'll correspond to some kind of catalyst, right? That is released from the crypto project, right? So they say, oh, we've partnered with whatever, or I think, what's the one? We've entered a collaboration, which is like they're paying for a subscription for Amazon Web Services, and they say we're collaborating with Amazon, and the
Yeah.
token goes up like crazy. And of course, that price action is being driven by manipulation, and all the retail is buying up at the top of that rally, and then the price falls again, and they just do the same thing over and over, and to differing sizes and different degrees for different cryptos. But I would say that yeah, most of the price action in crypto is basically an illusion. Like I don't think I would. It's too controversial to say that at this point. Yeah.
But do you think that a good project, good innovative project, needs this kind of an illusion at the early stages in order to actually grow? Because there is such a thing that is highly underestimated by a lot of people in the not only in this but in adjacent industries as well. But is being considered by those who actually succeeded back in the days. So there is such a thing as bandwagon effect, right?
Yeah.
So
Yeah.
you enter the shop where when you see that there are more clients there.
Yeah. It's so the I guess and that's kind of like the tricky thing. Again, it's like it's almost like a philosophical question. Is like if you can see that the only way that you can really bootstrap a crypto project is to have some kind of manipulation. I think that a lot of crypto projects go into that with that mentality, saying that the only way that we can kind of grow this is that we start off, we partner with market makers, we pump up the price, we suck people in, and it's kind of like short-term pain for long-term gain type of thing, right? Where yeah, a lot of retail that are aping it now are going to get smoked, but we're really dedicated to building something that is going to benefit in the long term. And again, that I know it's a little bit of a cop out answer, but I do think that it varies from crypto project to crypto project. And the thing that's really tricky also, is that what I've seen personally is that you'll see founders obviously change over time. Is that initially they're really dedicated into making something work, but then after some period they're just like, I just want to pump this thing and get out. right? And that's another thing, is that even a crypto project that starts off as something that is like well-meaning, high quality, had like a like some community allocation or whatever, and then over time it just becomes corrupted, either because you have someone else come in. There's unfortunately many cases like that. So long story short is that I think that many crypto projects feel pressured into doing stuff like that. Whether that's a winning strategy, I think it's kind of hard to tell, because especially in the modern day, a lot of people who've been in crypto for a long time, they know about these strategies, they know about this manipulation, and they're very skeptical of these VC high FDV crypto projects that launch pretty frequently. Yeah.
But when influencers receive discounted token allocations and promote them without disclosure, is that fundamentally different from insider trading or just a loophole the industry chooses to ignore?
So what's really fascinating so I come from especially over the last couple of years, I've kind of leaned more into like macro analysis, so not just crypto, but broadening out into macro. And what's interesting is that this idea of basically giving tokens to people to promote your crypto project is actually it's ancient. It's like hundreds of years old. It was done with stocks like in the 1700s or 1800s or whatever in the UK. And I can't remember the name that they would give to those people, but that's a practice that's existed for a long time, and arguably still exists today, and not just in crypto. And that doesn't mean that it's okay. I'm just saying that this is just how things work. But again, speaking from experience, working at one of these, you could say influencers from behind the scenes. In my personal opinion, and this might sound a little bit interesting, I guess, to those of you who aren't familiar with it, but you get this idea that influencers are given these tokens and they're going to like make all this profit and whatever. From what I've seen personally, it's not the people who are selling the tokens to the influencers are also kind of scamming you. Like, but I don't even know how to explain this, but and I don't want to use a specific example to like reveal too many details, but let's just say that if you're an influencer and you think that you're getting some sweet deal because someone's going to come and give you tokens in exchange for talking about a crypto project and whatnot. What happens very oftentimes is that you are just the sucker. That you don't you usually don't get the crypto for free. You have to pay for it also, with the assumption that you're going to make a bigger return. But what happens is that the cryptos that are being sold to you as an influencer, you're basically being scammed also. It's like they're selling to you at a lower price, but with all these lockups and whatever. Again, I don't want to give any specific details here, but let's just say that even the influencer kind of shilling thing, I think, has evolved to a stage where if you like, let's say, I don't know, in the previous cycle in 2020 and 2021, where it was very infamous, a lot of like, I don't want to name any names, but a lot of influencers were infamous for, without disclosure, shilling cryptos that they were invested in. In this cycle, from what I saw, was that if you were an influencer looking to promote, you have to buy the token, and like 99% of the time, when you bought that token, you would actually lose money. So they were all, instead of getting you to sell the retail, they were selling to the influencers who had money, right from the previous cycle, and they're like exit. So the influencers became exit liquidity instead of the retail in this cycle. Is from what I saw behind the scenes. So that's
And
just
this and the same influencer, besides being invested in this and scammed, he she, them, whatever, they've been scammed more than anyone else, right? And it is because not only they invested in this got scammed, but also they kind of put their reputation at stake, and that's
yeah,
hard to recover.
yeah,
But
hundred
look,
percent.
when a project backed by Donald Trump, World Liberty Financial, allegedly lets a handful of insiders control governance, liquidity, and blacklisting, how different is that really from traditional finance?
It's not different at all. It's the exact same. And I'll tell you, Nasif, again, I don't know how much experience you have in this, but the more that I research crypto, and especially now that in the last couple of years I've kind of started leaning more towards traditional markets, I just see like, man, what you see in crypto in terms of like the scamming and like paying influencers or whatever, it exists in TradFi just at a much larger scale. All the manipulation's still there. Nothing trades off fundamentals. Everyone talks about earnings and profits and blah blah blah. But man, like when you have stocks that are trading at like 50 to 100 times whatever they're bringing in, and then people say, "Oh, but I don't know how to trade Solana because it doesn't make any revenue." It's like, well, dude, your company is also trading at a ridiculous valuation that doesn't make any sense whatsoever, and the price is manipulated by insiders, by large pools of capital. So the short answer is that no. And you can make the argument is that again, there's nothing new, and I think this is something that's been mentioned probably in other crypto podcasts, especially by people who work in TradFi. They're like, look, like crypto's not doing anything new. Crypto's just like repeating all the mistakes of history, which is true to some extent. But by definition, like by that same logic, crypto is just becoming more like TradFi, by basically becoming more like insider controlled and manipulated, and VCs get all the insider access. And the moment there's an IPO, everyone who buys the IPO gets wrecked. Like it's the same thing, like launching a new token. Basically, that's kind of
I'm in
what.
the crypto since 2020, and I was so much keen to because I started studying finance, I changed majors and switched majors and so on, and it was like I was always in between TradFi and DeFi, right? So I was keen
Nice.
on learning both of the fronts and studying and researching and everything. So and I worked on like on both fronts as well. So the point is that what I realized is that along the way, when I was trying to learn every single instrument, investment strategy there is, and so on and so forth, in order to, step in asset management, back then that was the goal, I realized that in order to understand whatever here, I need to just go back to TradFi, learn the concepts, learn the basics, the fundamentals there, and then just understand how it's being implemented here. So that's the parallel for me. Yeah,
Nice.
and yeah, it works. It's absolutely valid. Now, if strategy is funding billions in Bitcoin purchases through perpetual dilution and preferred stock applications, is Michael Saylor building a financial innovation or a leverage structure that only works as long as Bitcoin never stops rising?
So is he building a leverage structure? So yeah, the whole thing around strategy. I'll start by saying that I'm not like an expert in the way that MicroStrategy has their debt structured. I think that you literally have to dedicate at this stage a lot of time to like looking into the specifics of like when is the specific expiration dates, when does that debt need to be rolled. Last I checked, and again this is changing all the time because they keep launching these new instruments like Stretch and whatever. But last I checked is that a lot of these debts are not due for a while. So even if there's some kind of refinancing, it's like theoretically, so long as Bitcoin's price, remains high in the not now, but in the future, like Bitcoin's price could crash down to whatever, and theoretically, MicroStrategy, theoretically being the keyword, theoretically, MicroStrategy would not be liquidated in the short term if Bitcoin was to fall. But if Bitcoin's price was to be very low, let's say in 5 years' time, or whenever those refinancings come due for that debt, then that's when MicroStrategy would come under pressure, is what I understand based on, again, it's always changing, but long story short, on that front is that it's it is financial innovation insofar as like it's doing a very good job of like pouring water from one place to another, so to speak, and incentivizing people to come in and buy with like offering them high yield bonds or whatever the stretch is, and then using that capital to allocate more Bitcoin. But yeah, it's not it's basically it's just like I mean it's kind of implicit in the question. It only works. I'll rephrase the question, and that's kind of the answer. Is that it works so long as Bitcoin it continues to rise, not now, but like in the future. So long as Bitcoin's price is higher in the future, in some whenever that debt needs to be rolled, then theoretically then it's fine. But again, in practice, it
Because
could be pretty.
capital gains or losses, they're not realized, right? So,
Yeah,
and
yeah,
as
yeah,
long as there is this thesis, it's living, it's thriving, maybe it's always also evolving and mutating, it's all good,
yeah,
right? So it's based on the belief, but the whole fiat system is anyways based on the human
yeah.
beliefs, anyways. To be fair, um, when a single company holds nearly 4% of all Bitcoin and relies on constant capital inflows to survive, what happens to the entire crypto market if that flywheel ever breaks? And I guess that's a very expensive question, right? That is
Yeah,
being constantly scrutinized on Twitter, on
yeah, yeah.
X.
So it's really interesting actually, Nasib, and I'm like it's a really interesting question, and I'll answer it in maybe like a different way because I do think it's something that's very interesting. So when I looked, and I still think it's the case, when I look at Bitcoin now, it actually looks very similar to what happened to silver in the 1970s, 1980s, when the Hunt brothers, like this group of billionaires, basically bought up. I think they bought up roughly a third of silver's tradable supply at the time. And if you apply that same framework to Bitcoin today, you start to notice that all these treasury companies that are accumulating Bitcoin and ETFs and whatever, they are essentially close to being one third of Bitcoin's of holding close to one third of Bitcoin's freely tradable supply. Because you have to remember that whatever 30% of Bitcoin has been lost. So you subtract that out, and then you take the amount that's left, and then see how much is held by these entities, and you realize, oh, it's also like close to a third. And why does that matter? Well, basically, what happens is when you have so much, whether it's MicroStrategy or these other Bitcoin miners or treasury companies, when there's so much Bitcoin that is being held by these entities that are not selling, then people say that Bitcoin becomes less volatile over time. I mean, I guess that's technically true in terms of the price, but I think that there's a point at which where if you have so much Bitcoin that is held, basically then the free float of Bitcoin that's tradable on exchanges is continuing to shrink, and everyone is so excited about that because it's a bullish sign. But it does increase volatility because if there isn't any Bitcoin in the order books, then it takes less capital to move the price. And I think that what we're ultimately seeing, and this is why I'm taking things a little bit different angle, is that the so it's almost implicit that eventually that flywheel will break. But what could happen before that flywheel breaks is essentially a parabolic rally that's driven by essentially it's been talked about a lot, and I think in crypto and in Bitcoin is like a supply shortage or supply squeeze or whatever you want to call it, where MicroStrategy and these Bitcoin treasury companies have accumulated so much Bitcoin and there's so little Bitcoin that is freely tradable on exchanges that every couple $1 million of buys causes the price to go up by 5% or 10% because everyone else is holding tight. So that is, and then the end result of that is that eventually in the case of silver is really interesting, was actually a rule change by regulators. There was a rule change that caused silver in the 1980s for that silver parabolic rise to stop. Is because of a change in regulation. So it's possible that that could be the thing that pricks the bubble for crypto as well. Is that in, let's say, in sometime in the next cycle, Bitcoin's going parabolic because there's so little of the supply trading. Everyone is buying, trying to get their piece of it. It's just going vertical. And then there's some rule change or something, or someone starts selling, and then the whole thing just goes down vertically, and that's the end of it. And I'm not saying that's going to happen, but I guess that basically that flywheel will break eventually, and it will probably collapse the entire crypto market. It's just a question
And
of
what do
when.
we have next? What do we have next after that? Because Bitcoin doesn't evaporate after that, right?
Yeah.
It's
So
there.
yes, but the interesting thing is, I guess, is that well, this is yeah, this that's a deep question. What happens after? I mean, personally, what I think is happening now as we speak is that we are seeing kind of like a merging of TradFi and crypto, where it's interesting. Of course, TradFi for a long time has been working on blockchain and DLT and whatever. That's been the case since 2017. But the problem with TradFi blockchain, same thing with the CBDC, by the way. The problem with things like CBDCs and TradFi blockchains that are technically not even blockchains because they're centralized, but anyway, the main issue is that those systems have not been battle tested in the real world. You have not had millions of people trying to ape into an asset within the same second. Like you see on Solana when there was a meme coin craze. It's really interesting actually if you listen to it's a little bit of a tangent here, but if you listen to interviews with Solana's founders, that meme coin craze on Solana over the last couple of years basically proved that Solana can handle, all these stablecoin transactions without the chain going down. And of course, it did used to go down. It used to have issues and clogging and whatever. But by having this meme coin speculation, you basically stress test the chain in a way that you will never ever see a private TradFi chain like they will never be able to stress test like that in a real world environment. Where people are constantly attacking, constantly trying to manipulate. Same thing with stablecoins. When you have something like USDT that's existed, I think for close to I think it's almost close to a decade now. Like USDT has been around for a very long time, and think of how many people are trying to exploit it, to attack it, to manipulate it, to do whatever. And after a decade of track record, you think, okay, am I going to release the CBDC or whatever into the wild where it could get hacked in 2 seconds? I don't know if you saw with the digital ID in Europe, they're trying to do like this online ID stuff, and it's just getting hacked. But if it's better to have something that is basically battle tested, so there's almost a necessity to merge between TradFi and crypto because yes, TradFi wants to have their own stuff, but they need the crypto technology because that's the only thing that's been stress tested. And of course, they can just copy and paste it because it's all open source. But what comes after that, I guess, Nasib, to answer your question, is that crypto merges with TradFi, and what happens with Bitcoin, like where Bitcoin plays a role in that, I'm not sure, because if we are entering kind of like an energy crisis period, then who's going to be mining Bitcoin? If energy prices are going through the roof and all the data centers are taking all the energy, whatever, is mining Bitcoin really going to be the top priority there? The only way that I think, the only way I guess you could say that Bitcoin continues to exist is in I guess in two circumstances. One where you continue to get broad-based stimulus, which is something that is not guaranteed. I think in the next cycles of stimulus will be much more concentrated. They do not want that stimulus to go out into the economy because it causes inflation. It's going to be very targeted into certain things. And then the second part is if you do see, and this is like the counter argument to myself, if you actually do see nation state adoption of Bitcoin, for example, I don't know, like Russia or Iran or these different countries using Bitcoin as a means of trade, they will continue mining it at a loss because that means that they secure the blockchain and they're able to continue doing transactions. So if you do see actual nation state adoption of Bitcoin, that's the only way that it survives in the long term. And that completely invalidates all these concerns around block rewards and all this stuff. That all disappears the moment that it becomes a national imperative for companies, for countries to mine Bitcoin to secure the blockchain to make sure it remains neutral so they can continue sending transactions. And that's why, in my opinion, you've seen such a push from the Bitcoin industry or people involved in Bitcoin. They're really trying to push governments to adopt Bitcoin, to mine it, to whatever, because that's the only way it's going to survive long term. Because the economic incentives by themselves will not be enough, nor will the liquidity aspect. Because I do think that liquidity will be abundant. Of course, they need to inflate everything away, but that money is not going to find its way into the markets the way that it used to in the future. I'm not saying that's in the near future. Obviously, that'll still happen, but if we're talking 5 or 10 years in the future, they're going to have some stable coin. They'll say, "Here's your stable coin to buy some food." And that stable coin is not going to go into Bitcoin. There you
Yeah,
go.
I think that I am actually informed, pretty well informed about what a systemic issue that a lot of people underestimate. The point is that the Bitcoin miners themselves are being pushed right now by their shareholders, by their investors to switch, and switch the directive towards AI.
Yes.
Yeah, and the point is that it becomes hard for the industry because it's a systemic issue. It's a systemic sabotage in a way, but at the same time, it's absolutely understandable because they need to maximize shareholders' value, right? As they say. So there is this issue, and I think like that's one of the rug pull effect type of things that isn't being counted in by many, and that's a bad
Yeah.
thing. That's bad for this industry. But let's see. If Bitcoin enters a prolonged downturn, right? Good strategies reflexive structure. So we have M&AV compression leading to weaker fundraising, leading to forced sales, risk become a systemic amplifier of Bitcoin's downside volatility.
Yeah, 100%. And it actually ties into your point, Nasib, about how you're seeing all these Bitcoin miners starting to pivot into AI. And as part of that transition, they're selling their Bitcoin, right? And a lot of these largest holders of Bitcoin are Bitcoin mining companies. So as these Bitcoin mining companies start selling their Bitcoin, then that puts pressure on treasury companies such as MicroStrategy. But MicroStrategy would probably be the last one to fall in that sense. It would be other ones that are more poorly managed. I think we've already seen, I don't know if it's in Bitcoin, but I know it's been in other treasury companies that have been forced to sell their crypto to basically start paying down debt. It's already happening in other treasury companies. Whether that's going to happen to MicroStrategy, who knows exactly when. It depends again on the debt structure. But clearly, some of these other treasury companies are much more vulnerable. So that's something that we're already starting to see in treasury companies, and it'll definitely hit MicroStrategy eventually. It's just a question of when. And of course, if all the markets are rallying again and whatever, then strategy has done, you could say, a very good way of buying themselves time. How long that time lasts, how high Bitcoin needs to be in that future date, I honestly don't know. I'm not knowledgeable enough about like the debt structure to give you like a specific number or point in time. But yeah.
Let's talk about DeFi because we have had quite a few interesting accidents recently happening. If a single signature in a layer zero Debian configuration can trigger a $293 million exploit like the Kelp DAO hack, is DeFi's core promise of trustless finance actually just shifting trust into invisible infrastructure?
Yeah, so this is where things actually get very interesting. If you really dig deep into this Kelp DAO hack, which digging deep, I was just reading some like some investigations on X. But
That's most of the people.
yeah,
That's what most of the people are
yeah.
doing, anyways.
But what's really fascinating though is there's an account, and I would strongly recommend checking it out. There's someone called Banteg, Banteg. I believe they used to be a developer on Urine Finance a long time ago in DeFi Summer in 2020. But they have they had a very interesting analysis, basically, of specifically this Kelp DAO attack. The way that it happened, again, the technical explanation is beyond me. But you can find it. Just find this person's X account, search for Layer Zero in their posts, and find this post. And what it basically explains is that the way that this attack on Kelp DAO was done, it must have required some kind of infiltration of Layer Zero itself. In other words, there was someone either associated with Layer Zero or working with Layer Zero who allowed this attack to happen. Is essentially what the post is arguing. So this was not so much a failure of like this whole DVN thing. And when you're talking about trustless nature of DeFi, I think that the code itself is fine. It's the people that is the problem, as always, right?
Yeah.
So there was basically everyone is treating this like it was a failure of the code, a failure of the protocol. But at least according to Banteg, and I believe it because you know it's a little bit of a longer tangent, but I could see already for weeks before this attack that you could see that there was a lot of pressure being put on Aave because Aave is the largest DeFi lending and borrowing protocol. It's the leader by a wide margin. And someone somewhere was really putting pressure, trying to get Chaos Labs to lead and like all this bad press around it, trying to like get people to scare people out of that crypto protocol. And then, whoever that entity or group of entities is, they finally succeeded with this Kelp DAO thing that scared, whatever a quarter or a third of Aave's TVL just fled completely because they're like, is the protocol even solvent now? And you have to ask it the question. I forget if show me the incentive, I'll show you the outcome. I think that was Charlie Munger or whoever. So don't be surprised at all if you start to see Morpho or one of these competitors all of a sudden starts to rise, and next thing you know, Morpho or some other lending protocol is the top. Just by who could have seen it coming, right?
Yes.
But basically what I'm trying to say is that a lot of these DeFi exploits and hacks, people assume like, and again, now it's going to sound a little bit crazy, like conspiratorial, but people say it's North Korea, whatever. I don't buy that for a single second. Maybe some of the stuff is North Korea, but a lot of it is attacks within the crypto industry between different factions. So you have like onshore, which is more like U.S. and you could argue like even Israeli ties, and then you have offshore, which is like China and Russia and whatever. And you could divide the crypto the crypto market into these two broad factions, and these two factions have basically been fighting, and you've been seeing it for years. Like even with the attack, even what happened to Terra, even what happened, there was an attempted, people forget this now, but there was an attempted run on Binance. I think that was around the time the Terra collapsed. Someone tried to orchestrate a run on Binance. Even Binance was pressuring, very fascinating thing, after the October 10th liquidation, last year. You all of a sudden saw Coinbase listed BNB, I think. You saw all the charges. CZ was given a pardon, and you saw all these different things that look like a backdoor deal was made. That someone was like, "I'm not going to let you have your bull market unless you give." And again, people assume it's CZ or whatever, but it's probably even higher than that. The people you see on screen are people who are in control typically. So sounding a little bit conspiratorial here, but when you pay attention enough, you start to notice, wait a minute, there was this bad event that happened. All of a sudden, you see these concessions. Then you started to see these headlines coming out about Iran using Binance, and it was almost like putting pressure on whoever is there, is like to try and get them to stop. It's just like it is all. It's very geopolitical, I guess you could say. It's a lot of very big, very influential powers basically fighting over the market. So long story short is that I think DeFi itself at this stage, I don't think that there's any significant problems. I think the trustless nature of the code itself for the most part is fine. The issue is the people. The issue is this competition between factions and this intentional basically exploits and you could say, I don't know if supply chain is not the technical term, but social engineering or whatever attack, where you're basically manipulating people at different companies into making mistakes, into giving information for the benefit of basically a competitor, whether it's like USDT versus USDC, or if it's Binance versus Coinbase, or if it's Aave versus Morpho. All these different crypto projects are fighting each other, and they are all beholden to much larger forces and pools of capital that are quite hard to fathom, I think, for most people. But anyway.
Do you think Bitcoin was created by CIA? Now that
Very,
we are in the
yes,
conspiracy
yes, yes, yes.
conspiracy zone, right?
It's really interesting, Steve. So whenever I tell people, I mean maybe not so much anymore, but whenever I used to tell people I'm like a head of research in Coin Bureau and I've been working in crypto for 6 years, the first question I would get is like, oh yeah, who created Bitcoin then? Ooh, like if you know so much, then I'll tell you. It's very simple. Bitcoin was created by either a person or a group of people that needed to move money outside of the financial system for whatever reason. It could have been criminals, it could have been governments, it could have been intelligence agencies, it could have been cypherpunks, like people who were just interested in this technology. And if you look at Bitcoin's history, it was probably a combination of all of the above. There was definitely government involvement, there's definitely CIA involvement, there's definitely involvement of criminal networks, there's definitely involvement of whoever. And so and this thing, like people really, you want to hope that it's very simple and say, oh, it was just the CIA or it's just whatever. But like with everything, man, is like what I see is a very clear battle, almost like for control and for influence, where you had the Bitcoin, the block size wars, right? You had like the people who wanted the smaller block sizes, the people who wanted the bigger block. And even in terms of the mining, right? Most of the mining was happening in China at some point. Now most of the mining is like moving towards the US. So Bitcoin is basically a technology again that I think was created by whoever it was created by almost doesn't matter. The bigger question is who is controlling the hash rate, who is controlling the protocol rules in terms of development at this stage. That is the thing that matters the most. But the short answer is that yeah, I do think that there was definitely, again, whether it was CIA specifically, I don't know, but it could have been someone that was a group of cypherpunks that was working on it, and the CIA approached them. You might know Nasib. I don't know about your knowledge of Bitcoin history, but how there was Gavin Andreessen and how he basically said, "Oh, I'm going to go speak with the CIA," and he mentioned this. I forget if it was in an email to Satoshi, and then Satoshi like left like some time after, and people speculate that that was the reason. Is that like Gavin started like working with the CIA, and so Satoshi like actually left. And again, but I think fundamentally again like the purpose of Bitcoin, the purpose of crypto more broadly, because people talk about, oh, it's about financial freedom and being able to move your money without restriction. Well, if you have a few $100s in the bank will let you move that money. They don't give a shit. Like, apologies for my French, but if you have millions of dollars or billions of dollars and then you're trying to move the money, then the bank is like, hold up. What are you doing here? Right. So when we talk about financial freedom in the context of crypto, when we talk about, banking the unbanked, we're not talking about someone who has $12 in their bank account somewhere in Nigeria. Okay. We're talking about someone who has hundreds of millions or billions of dollars that is having a hard time moving it because they need to move it, I don't know, for example, from a bank somewhere in Cambodia, and they need to move it somewhere into Europe. And then every bank along the way is stopping them, blocking them, saying, show me the proof, show me where the money is coming from. And, I'm sure a lot of that money is clean, but is dirty, but not all of it. I'm sure that there's some people that genuinely are like, look, I'm trying to get my money out, but my government is blocking me. So they go into Bitcoin and they move it out that way, right? And you end up with this whole mix of different, again, not just different types of people working on it, but it's fundamentally, again, Bitcoin and crypto more broadly is a technology to move value outside of the financial system. And you have to ask yourself who needs that technology, and those are the people who are funding it and paying for it. That's that simple. Yeah.
Let's stop for a minute. Here's a brief moment of context for those who may not know me. My name is Nasib Fathi. I'm a scientific researcher in the blockchain space, and I work with executives and organizations as a growth and media professional. My focus is crypto at the intersection of institutional finance, market structure, and regulation. You are watching the NFK podcast, where these topics are discussed through conversations with people shaping the development of digital assets space. When a single exploit can cascade through Aave or Aave, Compound, and other protocols, wiping out $10 billion in liquidity within hours, is DeFi truly composable or just dangerously interdependent?
So it's both. It's composable and it's dangerously interdependent. I think the one thing that's not factored into DeFi enough is the kind of perverse incentives that are created. Very simple example is like with Athena, where you can like mint this SUSDE and you can have like, I don't know, let's say 4% yield or 6% yield or whatever on the stablecoin. Then you use that yield bearing stablecoin as collateral and you borrow stablecoins and you mint it and you just loop it, over and over and over again. Then you have billions and billions of basically looped capital earning some interest. This is the kind of perverse stuff, which again, I'm sure TradFi guys love it. I'm sure DeFi degens love it. But that is the type of you could say. Hold on, I'm trying to let me remember that word. Dangerously interdependent. That's the kind of like dangerous interdependency you could say. Is not necessarily that you lend from one place and you borrow to another. It's when you fold it over and over and you're just rotating that money into a loop over and over. That's when things get very dangerous. Yeah.
There is a whole strategy, investment strategy called
Yeah.
called literally like yeah, looping, right? So
Looping it.
yeah, yeah. So if Hyperliquid, but no, actually, let me add another thing. I believe crypto, and it's not only me who thinks so. I think crypto is just having its identity crisis, right? Do you think we need to stop pretending that you know crypto is just something different from TradFi, it's something completely new, and just accept the fact that it's something amplifying already existing systems
Uh,
and
so
introducing new adjacent structures that can add value on top of what's already there.
so this is where that distinction, of course, I'm sure you've heard many times before, is like there's Bitcoin and there's crypto, right? That they say
Yeah.
there's like Bitcoin is not crypto and whatever. So in this case, I would definitely draw that differentiation where Bitcoin, many people would argue Bitcoin's not undergoing any identity crisis. Bitcoin is everyone is digital gold, right? It's or you could say, oh, it's digital cash and whatnot. That's an old that identity crisis is already over. That's old news. At least as far as the main, let's say, consensus view is concerned. When it comes to crypto in terms of identity crisis, definitely like there's like, you know, there's you could say there's an understanding that the only way that crypto can grow is to integrate with the traditional financial system, but there's a reluctance to do that because people know that the financial system has a lot of constraints and is becoming more constrained, and people don't like that. Even and this is where I was mentioning before about who's invented Bitcoin and moving money outside of the financial system. Even for me, and this is probably true of anyone who's actually used crypto. I'll give you a simple anecdote. So when I went to the bank to get a credit card, I basically, like where I live, I basically had to provide like all this like documentation, and the manager had to like come and speak with me, and it was like crazy. And like it wasn't because of my field of work; it was just because it's so hard to get a loan or a credit card. Like they just want all this information, they want all this stuff. And then I went in DeFi and I just used my Solana as collateral, and I borrowed the same amount of money in 2 seconds with no friction. So that is the thing that I think a lot of people, for people who know how to use this technology, and now we're going beyond the idea of how much money you have, but if you know how to use crypto, very intimately, then the idea that crypto would become more like TradFi is literally nauseating, because you're like, I don't want to have to go through some KYC BS at every single step of the way I do in TradFi, where I'm just trying to transfer $100 to my mom, and the account is blowing up in my face and saying, we need a scan of your face right now to prove that it's you sending my, like, Jesus, man, like I'm just trying to send $100 to my mom, right? And so that's the, I guess that's the, it's not even identity crisis. It's like recognizing that the only way to grow is to kind of move into this sphere, but people don't want. There's like a, there's been, it's been not like brainwashed, but it's been burned into our brains for the last 10 years or however long, especially after Ethereum came out, that we do not want, we want to be decentralized. We don't want to have any kind of like trusted gateways or any gatekeepers. We want everything to be decentralized. We want to do whatever we want with no restriction. And when you get used to that, like I don't want to. It's the same idea. It's like, you used to, I don't know, you used to work in a cafe, or like, you used to work in a restaurant. You could dress however you wanted. You were making good tips, making money under the table. You don't have to report anything. Just be sure to report your crypto taxes, guys. I'm not advising not reporting crypto taxes, but you know what I mean. It's like you're working in an informal setting. You're making good money. You're liking it. And then someone comes along and says, well, you can make more, but you're going to have to wear a suit. You're going to have to show up on time. You're not going to be able to take the money under the table anymore. You're not going to be able to do all these different things that you enjoyed. You're going to have to clock in every day. You're going to have to track everything. And then you're thinking like, shit, do I really want to, you know what I mean? So this is the kind of identity crisis that crypto is going through right now.
And a lot of people
Yeah, yeah.
in crypto as well.
Yeah, yeah. And yeah, so I'll leave it at that. Yeah.
Hyperliquid now controls approximately 70% of decentralized perpetual futures trading. Is it still a decentralized exchange, or has it become a single point of systemic risk for the entire space? On the other
Yeah.
hand, now that I think it again about this question, yeah, they I think their founder just expressed his view regarding this in plain English, right, and put it in plain sight. We want to become a house of all finance, right?
Yeah, yeah. Well, I mean, so Hyperliquid, I mean, first of all, it should be noted that whether it's Hyperliquid, whether it's Solana, even arguably, but Hyperliquid in particular is very centralized. With each iteration, crypto becomes more centralized. So Hyperliquid itself is already very centralized. They stopped the, whenever there's like some market that's being manipulated, and the HLP, like that, basically reserve of capital, is starting to be drained, then they basically shut it down, and they shut everything down. So, as far as I'm concerned, that's not really it's not very decentralized. And yeah, like whether it's a single point of failure, I wouldn't say it's a single point of failure for crypto, but it's definitely one very, it does present systemic risk, I would say, to on-chain DeFi, similarly to Hyperliquid, like, similarly to Aave. Anything in DeFi that involves lots of leverage is inherently a risk, because the main thing is that you never know. I mean, in DeFi it's a little bit easier to tell because you actually see on chain, but you never know how all that leverage is combined. So I'll give you a very simple example from 2022. You might remember that Celsius was basically lending client money into Terra. So there's a potential situation like that where And I think it was even within the case of Aave, I'm not going to name any names, but there's some exchanges that are lending crypto on like hundreds of millions of dollars of stablecoins on Aave. So if Aave was to go down, those centralized exchanges go down too. And I'm sure it's the same idea with Hyperliquid, where maybe there's some exchange or someone is providing, liquidity on Hyperliquid, and if Hyperliquid goes completely to the toilet, and that entity was providing, I don't know, $1 billion of market making capital to Hyperliquid, and Hyperliquid goes under, and that company loses $1 billion, then it does kind of spread out from there. But it's you never know. You never know how intertwined that leverage is until it's kind of like too late, essentially. So yeah, it's definitely a systemic point of failure for DeFi. And it could also spill into potentially into CeFi or whatever you want to call it. Yeah.
Hmm. Look, are Bitcoin ETFs primarily a demand expansion mechanism that strengthens Bitcoin's monetary premium, or are those just a custody abstraction layer that progressively displaces self-custody and erodes censorship resistance?
So I mean, Bitcoin ETFs, I would say, are primarily, yeah, demand expansion mechanism. I mean, I guess you could put it that way. Um, yeah, I would say that it's primarily a expansion mechanism. Um, and eroding censorship resistance. I don't necessarily think, again, like, who holds the Bitcoin doesn't necessarily matter. It's more about where the development, who can, who influences or who controls the development, and who is running the nodes and doing the mining. Right. That's basically the most important thing. But one thing you might know, though, Nasib, is that some of these Bitcoin ETFs, they're taking a portion of the revenue and they're using that to fund Bitcoin mining. So to fund Bitcoin development. So insofar as that is it, so if you were hypothetically to have, like, I don't know, some ETF that is like funding to, aggressively funding like Bitcoin development, then that basically becomes a genuine threat to decentralization of Bitcoin. Arguably, like, that you have one entity that's very impactful. But in terms of like who holds it, probably doesn't necessarily matter. Like, for example, I'm sure you might know that a lot of, or not a lot, but I'm sure that there's quite a few people that, before maybe they were holding Bitcoin on Coinbase, but now they just started holding Bitcoin in the ETF. And I mean, it's the same custodian, but it's but it's a lot of basically, I don't necessarily think that the custody aspect matters as much. I know this is something that Bitcoiners are really big on, like, don't let them have your coins, but the
And
bigger,
custody
yeah,
services providers as well. I just
yeah,
did
yeah,
this
yeah.
once. So, yeah.
But I wouldn't say it matters as much as, like, you could very easily argue that the fact that you now have that increased source of demand for Bitcoin is arguably more important than, like, the few hundred, because, like, I mean, some really hardcore Bitcoin people might say, no, 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 like, we want these dumb people to use self custody because they'll lose their Bitcoin, and then it makes my Bitcoin more valuable. Well, it's like, well, that's a little malicious, but but long story short, though, is I do think that the demand aspect is that the increased demand coming from the ETFs is much bigger. The ETFs are a bigger net positive than they are a net negative as they are currently structured, in my opinion. And that could change in the future, obviously, but we'll see.
Does CME Group's move to 24/7 Bitcoin and altcoin futures improve price discovery or shift it toward the institutions such as BlackRock, Morgan Stanley, JP Morgan that already dominate the derivatives flow?
Yeah, so that's a really good question. It's complicated, and I'll start by saying this, that it's widely believed among hardcore Bitcoin traders that Bitcoin started being manipulated the moment that the Bitcoin CME futures launched back in, I think it was December of 2017. It's really interesting, actually. Since that time, Bitcoin's price actually behaves very differently than it did prior to that period. So insofar as that is true, then you could make the argument that, yes, like, as basically as Bitcoin or altcoins or whoever becomes more integrated with TradFi, more exposed to those capital flows, then logically it becomes more exposed to whoever's doing, the manipulation or lack thereof on that side. The very And I guess you could say that the shift to 24/7 specifically, because that's a little bit of a different thing. Like, before, there was a CME gaps and everything, but the shift to 24/7 specifically is is interesting, and it's, I guess, I wouldn't necessarily say it improves price discovery. I would say it improves price stability, because, of course, the main issue with the 9 to 5 Monday to Friday with the CME was that when there was a weekend, then it would create the CME gap, which would need to be closed because the basis trade. As a fun fact, the basis trade is not being done as much by institutions over the last few months, and this is precisely why the CME gaps are not getting filled the way they were before, and why no one's talking about CME gaps anymore. It's because the institutions stopped doing the basis trade using the CME and the spot, or whatever, the spot Bitcoin on the ETFs, or whatever, however they were doing it. But because institutions stopped doing the basis trade using the CME futures, the CME gaps no longer matter as much as they did, and they're not getting filled as much. But when it comes to, again, the 24/7, I think that just removes the CME gap. It doesn't necessarily, improves price discovery. I mean, when you I mean, how much discovery? Again, if we kind of follow the assumption that like the markets are mostly manipulated, not just in crypto, but more broadly, price discovery doesn't really exist. It's just manipulation essentially. But does it shift towards the institutions? I think it shifts towards whoever has the money and the interest in moving the price of that asset around. People like to paint like institutions with a broad brush, or like whoever. But if it's whoever what futures and like these kind of like regulated TradFi products for crypto ultimately do is they make it possible for other pools of capital that previously were not able to access crypto. They're able to access it for either good purposes or bad purposes. Like good purposes because they want to stack Bitcoin, or bad purposes because they want to manipulate an altcoin on some exchange and make some profit. So, you know,
No, if Bitcoin now behaves like a high beta macro asset, and it's arguably tracking the Nasdaq, reacting to tariffs, moving with ETF flows, can it still function as a censorship-resistant store of value, or has institutional integration fundamentally changed what it is?
I was waiting for this question. I almost answered it a little bit prematurely, and I apologize if I'm like giving very long answers here to the questions. But so you know, you have to. It's very easy, especially if you've been in crypto for a long time. It's very easy to look at crypto from within the crypto market, and you're kind of like living in your own like bubble or whatever. I'll give you. I'll just. I mean, I don't want to like necessarily pose a question to you, Nasib, but I'll just pose it like a rhetorical question. So, Bitcoin trades mostly against USDT. Tether is one of the largest buyers of Bitcoin. And as of late last year, according to Tether CEO Paulo Arduino, Tether is also the largest miner of Bitcoin by hash rate. So you have one entity that dominates the price, the price discovery, or I guess issues the crypto that's used for the price discovery. I'm not saying that Tether's manipulating anything, but they provide the instrument for the price discovery. Most Bitcoin trades against USDT. Tether is a big buyer of Bitcoin, and I'm sure that they're all Tether is also one of the largest lender in crypto, the CeFi lender. So they're probably lending, for example, to Bitcoin treasury companies so that they can buy Bitcoin. That's one thing to keep in mind. And then you also have Tether being basically the largest Bitcoin miner, according to Tether CEO Paulo Arduino. So when you have those three things, and let's just say you're someone who's never heard of Bitcoin before, you're an institutional investor, and you discover this in your research, does that look like a safe haven, or does that look like a risk asset? That looks pretty damn risky to me. So in my view, this is precisely the reason why Bitcoin trades like a risk asset, is because it is a risk asset, and like at a structural level. Like again, I'm not saying that I believe this. I'm just telling you from the outside looking in. You hire some institutional guy who's just like an actual head of research. Okay, like not like not like a guy who's like me working for a YouTube channel, or was working for a YouTube channel. You have an actual head of research. He's going to find that stuff in like 2 seconds. It took me a couple of years to figure that out. He'll figure that out, and in like probably a couple of days, he'll be like, no, like I'm not allocating my client's capital to this. Like this is insane. It's all dependent on this one company that is constantly under regulatory scrutiny. No one knows what's going on with their accounting. Although Tether will be doing this
By the end of
audit.
the year.
Yeah, they'll be
Yeah.
doing this audit. So that will probably change things a little bit, but it doesn't change the fact that they look and they say, hey, one entity is very involved in basically from top to bottom, and for everything on this Bitcoin. This does not look like a safe haven to me. It looks like a risk asset. So, um, and yeah, so can it still function as censorship as store of value? So it's still censorship resistant, 100%. But I think Bitcoin will always be censorship resistant no matter what happens. Whether it's a store of value, that's the other question. Some people would argue that that tech stocks are a better store of value than gold and whatever, because you have the it's also it's not only resistant against the increase in the money supply, but it's also technology that's actually growing and scaling, and like AI and bringing in revenue and all this stuff. And one quick thing on that note, sorry to cut you off. One quick thing to keep in mind is part of the reason why crypto has performed so well over the last decade is because the two sectors that have performed the best is technology and finance. And if you combine technology and finance, you get crypto, and that's why crypto has done so well. Anyway.
Given the fact that the energy crisis is inevitable at this point, it's interesting how Michael Saylor will use that in order to strengthen his store of value argument, right?
Yeah.
Do you have any ideas regarding that?
So, I mean, I'll kind of
Just,
again.
I would just add just one more thing.
Please,
I
please.
kind of feel like Bitcoin in general, it really needs this kind of stories. It really needs parts of its resistance, not necessarily censorship resistance, but just an ability to survive. Is just using these narratives, whatever happens, especially now at the geopolitical level, just using it in its favor. And it already also needs conspiracy as well, because that was part of the thing, right? Part the ideology, all the conspiracies, all the stories, narrative. It's a narrative driven market. It still is, right? And Bitcoin, it's a necessary part of this whole thing. So do you think that one of the next really strong narratives will be energy crisis connected one, and yeah, it will be connected to the store of to the Bitcoin being a store of value?
No, no, I think the because again, Bitcoin is a who is it that mentioned it? You have an inflation hedge, and then you have like sorry, you have the monetary debate. So you can say
Quite
there's
a few
two
things, right? At this point.
yeah.
Yeah.
There's two sources of inflation. You could say that you have supply side inflation, which is like an actual supply chain disruption, and then you have demand side inflation, which is like they printed a bunch of money, which creates more demand and makes it possible for you to buy stuff. When you have monetary debasement, like an increase in the money supply, Bitcoin is a hedge against that. What Bitcoin is not a hedge against is when there is a supply chain disruption of some kind. And by the way, I don't think that gold is a hedge for that either. And there's a very interesting thing actually, but I guess this is kind of like contradicting my own point here. But just the fascinating thing to keep in mind, maybe going in the future, is that um, during times of hyperinflation, what's really fascinating is that gold actually lost value in real terms. Like, yes, of course, it held up better relative to everything else, but gold would lose value in real terms. Why? Because if you're actually in a hyperinflationary environment, and I guess not only if you're in a hyperinflationary environment and you're selling your gold, it's because you've already sold everything else. So the person who's buying from you, they say, "Oh, you're selling your gold, huh? So then I want a 20% discount." And that's how the gold price basically falls in real terms in a hyperinflationary environment. So I guess what I'm trying to say is that if we were to enter hyperinflation, Bitcoin would also, in real terms, of course, it would hold up better relative to the currency, but it would actually potentially fall in real terms as well, which is hard to wrap your head around. But anyway, on the on the supply on this when there's a supply chain disruption like an energy crisis, Bitcoin miners are going to get squeezed, so they're going to have to sell. And of course, Bitcoin is designed to accommodate that. So the hash rate will decline, and the difficulty will decline as well to match that. So Bitcoin itself will not disappear or anything like that. But what will happen is, when there is a supply disruption, then the only thing that matters is whatever, I guess you could say in this case, what matters the most is energy. And people are going to say, oh, like there's all these Bitcoin miners that are mining this Bitcoin. It could be used to power all these homes here, which are paying a huge amount of money. And they're going to say, you might remember actually this, Nasib, because I think you're based in Europe as well, that when there was this energy crisis after Russia invaded Ukraine, I think there was like the European Union was trying to ban Bitcoin. I mean, I don't think there's much Bitcoin mining being done in Europe anyway, but they were trying to ban it entirely because they're like, look at all this energy. We have this precious energy. We cannot allow it to be used, like for Bitcoin mining. We need to redirect that into the grid for other people. And I think we'll see if there is an energy crisis, this is exactly what we're going to see. And obviously, it's not going to be good for Bitcoin. It's not going to kill Bitcoin because there's always going to be someone mining somewhere. I remember there was a video I saw, and I wish I saved it. I think it was on X, some guy, I don't know, in China or Thailand or something, and he's mining. He's using he basically created like a water, like he basically put like a huge thing in a river, and this thing is like spinning and generating power, and then he has these Bitcoin miners in a cave with Starlink or some Wi-Fi. He's basically
I
mining.
think I saw it. Yeah.
Yeah, he's mining in the middle of it, and like, so those people are always going to exist. So the Bitcoin's never going to go down to zero. Like, it's not going to go down to zero, but people will immediately, they'll say, do I want this magic internet money or do I want to heat my home? And they're gonna want to heat their home more than they're gonna want the magic internet money. you know so that's the thing. Yeah, man.
We touched upon the topic of digital gold, right? That
Yes.
thesis. So has has Bitcoin permanently failed the digital gold thesis, or is it, or is its current behavior just liquidity-driven phase that will reverse under different macro conditions?
Yeah, so again, like, whether Bitcoin is digital gold depends on whether you think that, if you think digital gold means that it's a hedge against not inflation driven by supply, but inflation driven by currency, like debasement, like increase in currency supply. If there's then yeah, like Bitcoin is digital gold insofar as if the supply of money increases, then Bitcoin will eventually reflect that. And so that it is a store of value, same way that that gold is. But the difference, I guess you could say, is that Bitcoin for the time being is not recognized as a actual, safe haven among, for example, central banks, which again, I think that is the big thing. And just to give a little bit of history to people who might not know, prior to the 1970s, gold was the main reserve in central banks. And then after the fall of the gold standard in 1971, then central banks around the world started holding US bonds because when the US dollar became the world's reserve currency, I mean, it was always the world's reserve currency before that, but you actually need it. But the dollar was backed by gold. So if you have the gold, then you were theoretically like, if you need dollars, you can sell the gold and you can get your dollars. But the easiest way to kind of get dollars in the post Bretton Woods system was to have the US bonds, which would pay a yield, right? So you could keep all your extra US dollars in US bonds and you would earn interest. It's kind of like a savings account for these central banks. And you can use those bonds and use that yield and use those US dollars to protect their currency, to do international trade and whatever. But what we've seen since 2008 is you're starting to see a return to the old system where more and more central banks are starting to buy more gold and people think it's some new thing, but they're just going back to the system that existed before 1971. They're thinking, well, we're not really, we're not too keen on holding US government debt. What else are we going to hold? And like, well, we used to hold gold like 50 years ago, so let's just start holding that again. And the only way that Bitcoin becomes on par with gold is if central banks say, actually, I want to buy a little bit of gold also. And as of, before someone mentions in the comments, I'm almost 100% sure, at least at the time of shooting, that there is no central bank in the world that holds Bitcoin on its balance sheet yet, unless you count the Czech central bank, which has technically a small allocation, but it's in a test portfolio or something. But there is no central bank that holds gold, at least not one. I'm sure that there's some central bank in some like tiny country that like no one's ever heard of, and maybe it holds a little bit of big. I know there's like some Bitcoin ETF holdings or something like this, but that a bank would declare, Bitcoin to be some strategic reserve asset that has not happened yet. Not even in El Salvador. It's held, I think, separately, and it's not. It's by the government. There's many governments that hold Bitcoin, but there's not any central banks that hold Bitcoin. Is what I'm trying to say. Anyway, the moment that if that was ever to change and central banks do start buying Bitcoin, then it becomes, like a true, you could say like safe haven and like a true digital gold. But until like at least in my view. So yeah, like again, if you think digital gold is just like, that when the money supply increases, that the value goes up, then Bitcoin is digital gold. But then in that case, you can make that argument about basically everything. But like everything, is anything with anything with a limited supply is like a digital gold. Granted that it can be traded digitally. Going on a tangent here now, but yeah, I don't think that Bitcoin has failed as digital gold insofar as it is a hedge against the increase in the supply of currency. I think it's still a hedge against that. It's just that now we're, as the question notes, we're in this liquidity phase where liquidity is declining. I know that the markets are rallying as we record, or we're rallying as we record this. That's mostly a short squeeze topic for another time, maybe. But yeah.
Does Mastercard's crypto stack, Crypto Credential, MTN, CipherTrace, and partners like Circle, Paxos, Binance, Solana, and Avalanche effectively reframe open crypto rails into a KYC gated payment network?
Yeah, basically, yeah. The only thing is that we're probably not going to see to get true mass adoption of public chains. They need privacy, and that's the thing that is kind of and that's where Avalanche. That's part of why Avalanche is so popular, is because you have these subnet. You can make these subnets, and you can have these different. Same thing with Canton Network. I think Solana's working on different types of privacy as well. But yeah, essentially, yeah, there is a I think all of these TradFi institutions are trying to bring crypto into a lot, not all of them, but a lot of them are trying to bring trying to bring crypto into the TradFi fold because it's more efficient. You can have instant settlement and whatever. But the problem is that again, is that privacy aspect, and that's where things are going to get really interesting because we could have private chains built as a derivative, for example, of Avalanche or Canton Network, and you could say, well, is Canton Network really if someone is using Canton Network, are they really using it if they're running their own private and permission chain? But it's connected to the overall thing. It's tricky. It's tricky.
And if Visa, MasterCard, Stripe, and banks like JP Morgan and Standard Chartered converge on permissioned blockchain infrastructure, does liquidity and price discovery systematically migrate away from DeFi, and does that neutralize Bitcoin's original peer-to-peer settlement model?
Oh, that's a big question. Yeah, I think again, the permission blockchain infrastructure they will use will be fundamentally crypto based. In terms of liquidity and price discovery migrating away from DeFi, well, that's the thing is like if you have, again, just to use an example, if you have something like Canton Network where it's connected, or even Avalanche, where you have something that's like a main chain that's connected to all these other chains, and then the main kind of chain becomes the hub for all the trading, and that is done using some permission DeFi stuff. again, it's very hard. I think we're going to enter a period where it's going to be very hard to draw the line between what is permission. I mean, obviously you'll know what's permission, but what counts as DeFi? Like if you have Visa, Mastercard, and Stripe, using some, Solana introduces, I don't know, some like private shard or something, and Solana and sorry, and Visa, Mastercard are using that private shard. Is that private shard technically DeFi? It's, again, hard to say. And in terms of a neutralizing Bitcoin's original peer-to-peer settlement model. Um, yeah, I think the settlement will always be done, unfortunately. At least, I mean, again, it's a whole other can of worms, but at least for the foreseeable future, it looks like settlement is going to continue to be done in US dollars. There's a huge incentive in the way that things are moving to basically introduce, and I'll use actually a very simple example. So in 2017, 2018, you had that ICO boom, right? And the way that you participated in the ICOs is you use Bitcoin or Ethereum. I think we're going to see something similar come along in the next cycle in the coming years as regulations improve. We'll have like a tokenized RWA kind of like ICO wave, but you're not going to use Bitcoin and Ethereum to invest. You're going to use stable coins, and you're going to require KYC. So that's going to be that's kind of like the way that things are headed. And yeah, and I think that there's just a massive incentive, not just from the US, but from governments worldwide, if they can, perfect the stablecoin model where it's backed by debt. It's like, why would I agree to settle in Bitcoin if I can settle in stablecoins which are backed by US government debt, and I can artificially create demand for this debt, to subsidize the debt and keep interest rates low. That is really the name of the game here, and that's where crypto is going to play a big role, I think. But anyway, tricky question.
And is the push to ban stablecoin yield through legislation like the Genius Act primarily a systemic risk safeguard, right? Or a coordinated effort by banks to preserve net interest margin by preventing capital flight from deposits? I think the second.
Yeah. I think it's
Which is understandable, right? Business-wise,
yeah,
it's a correct move.
yeah, but it's very tricky because, like, again, I've actually done quite a bit of reading and research into, like, even in terms of when it comes to like CBDCs. Um, I think that there obviously, like, if there was to be some yield on a stable coin, then it could theoretically, cause deposits to flee. But the thing is that, and one thing that people really don't understand is that a stable coin is not as trusted as money in a bank. And, there's a guy who gets a lot of hate, but I think he's really smart. What's his name? Nader Al-Naji. He was the founder of BitClout and then DeSo, like this decentralized social media. Basically, this is a crypto founder guy, and again, he's pretty controversial. I think he's even been like accused of different things and whatever. But he used to work on a stable coin startup like back in the previous cycle, and he made a very interesting observation. He said stable coins are seen as inherently risky by the people who use them, and there must be some kind of reward, some kind of compensation for holding the stable coin. So, for example, Tether doesn't like USDT doesn't earn a yield, but you can use USDT to buy an altcoin or leverage trade on an exchange. Same thing with USDC. USDC doesn't earn a yield, but you can lend it on in DeFi. So, what Nader
I
is
also
arguing,
think that yield sharing models will prevail over time.
yeah. Well, like what Natter's, I mean, again, it's not. I think people get too fixated on the yield and they don't think enough about, you have the reward, but you also have the risk, right? If you have a stable coin that pays no yield, but it's issued by JP Morgan, it'll probably be bigger than a stable coin that's issued by some random tiny company, but it's offering like a 5% yield. You might actually not see that much capital go into that smaller, theoretically you would see people go into it. But if it's some unsecured, uninsured institution versus a systemically important bank that is, completely safe, then people are not going to. I think the stablecoin thing is related to your question earlier about crypto having an identity crisis. I think banking is in a similar place where it's like stablecoins, like banks want to launch. There's nothing stopping them from launching their own stablecoins. Okay, so that's the main thing, is like the idea that, oh, we're scared that deposits are going to go out. Well, they'll just launch your own stablecoin. Problem solved. So what is the real reason why they're pushing back against it? It's because they don't want. It's the same way like with crypto, working in the restaurant versus like having like a. They're like, oh, like I don't want I don't want to have to launch a stable coin and maintain it and like deal with all the KYC and like all these different things. Like the banks are, I think it's not a question of financial stability. I think it's genuinely a question of laziness and almost like even like reputational risk, right? They're like I don't want to have to launch my own stablecoin because if something goes wrong, then I'm in trouble. But it's like I don't want I don't want to take the risk. I don't want to go that way. But they will eventually. Like they're already planning it. So and JPM has their stablecoin. So again, I don't think it's a question of financial stability or whatever, because the banks could launch their own stablecoins, and I think that it would wipe the floor with USDC, USDT. Those are all cooked. The moment that you get some trusted institution, some trusted bank that is launching their own stablecoin, offering a small yield, even if the yield is smaller than USDC, USDT, the trust makes up for the difference, and you're finished. And they would not lose anything in turn. Well, I guess they would lose deposits internally because it would go from being in the account to going in their stablecoin. So maybe there's some argument to be made there. But I'm sure that they would hold that asset on their balance sheet, so it still wouldn't affect anything in that case. So again, I don't think that this. I think it's genuinely that banks are like, we are not prepared to jump into it this way, and we don't want to do it. But there's nothing stop. But they could, if they do what, once they do it, like all these crypto companies that are established. Like I'll mention on a side note, Nasib, that my personal conspiracy is that one of these major stablecoin issuers is going to go under and is going to get acquired by a bank or whatever, and then that'll be it. Like whether it's Circle or Tether or Paxos, or there'll be some systemic issue. At some point, one of them will go down. And the banks will say, "Okay, guys, we let the stablecoin guys try it. Now we're going to do it properly, right?" And they're going to come in and they're going to offer a yield, and there's going to be no issues whatsoever. That's how it's going to go, I think. So yeah.
If permissionless DeFi protocols continue offering higher yields despite regulatory constraints, will liquidity structurally migrate away from US banking deposits toward
Totally.
on-chain markets, effectively undermining fractional reserve banking?
Um, I think the answer is I think the answer is yes, only if it's possible to access those yields, at a large scale. Because the thing is that those yields already exist. Like even in the previous cycle, you could lend UST, right? This or not lend, you could hold a Terra stablecoin UST and earn a 20% yield or whatever it was, right? So we've already seen many cases of like stablecoins offering double digit yield. I'm like, yeah, some money moved in there, but it was mostly opportunistic capital. It wasn't people moving money out of their banks and going into DeFi. So I think the moment that it becomes easy, if it becomes very easy that you just have like these super apps, right? Like where you have everything in one place, and when it becomes easy to move money out of your bank account directly into some stablecoin protocol, and you don't even know that it's DeFi. You just say, I want to earn a yield, and you can just click one click to earn a yield. If that becomes widespread, then yes, then it becomes a risk. But so long as those usability hurdles exist, then I don't think it's really it's I don't really think it's a threat, because it's not a practical threat to the financial system. It's like people really hype these things up, but the average person doesn't even know how to make a MetaMask, dude. Like, who how are they going to put their whole you're telling me you're going to see hundreds of billions of dollars flowing in through MetaMask? I don't think so. Into Aave. It's all opportunistic capital. Yeah, man.
If private credit has grown into a $3 trillion shadow banking system with higher default rates than 2008, are we already inside a new financial crisis or just waiting for it to become visible?
So the short answer is that no one knows, because no one knows how widespread the risks are. It's extremely opaque. What private credit has in common with mortgage-backed securities from 2008 is that it's very opaque, it's very complex, and there was a third one, but I can't remember. Opaque, complex, and I guess you could say illiquid. I guess you could say technically, because it's not necessarily. It's all it's not trading publicly or anything like that. Um, but yeah, like I personally think that private credit is going to become a systemic issue. But again, I think it's already becoming visible, and it's interesting that you asked me that, Steve, because there's a lot of people that have been wondering, why the crypto market didn't perform so well last year, especially altcoins. And in my own personal analysis, I think what happened was that there was systemic issues in private credit that started affecting the crypto market first, and then it started spreading to the rest of it. Then it spread basically to the rest of the market. And now we're at a stage where it's all over the headlines or whatever. But if you actually go back and you trace the history, what looks like what happened, well, I mean, you can go back even further, that the crypto industry has historically had a very hard time securing banking relationships. So it was very hard for crypto companies and crypto projects to open bank accounts. And the idea that they could borrow money, like to take on a loan as a crypto exchange, that's the bank is not going to give you that. You would have to go to a private credit entity and say, I need to borrow 100 million. And then they would charge 10% or whatever. So as a result of this happening over years and decades, the result is that crypto and private credit are like this. They're like, so the moment that there was issues in private credit, it started affecting the crypto market first. And these issues, you could theoretically trace them even to the interest rate increases of 2022. But you can see very clearly that sometime around the spring of 2025, which is when we had the Liberation Day tariffs, like Trump came in and all the markets fell, there was that is probably the first instance where there were strains in private credit. Private credit lenders started pulling back, and what that means is that there was less money. For example, let's say you're in crypto, you're a market maker, and everyone assumes that market makers have all this money, and they do. But oftentimes that money is lent to them from someone else, so they're giving them and they're earning some yield on that. And they're keeping a difference. So let's say hypothetically you're a market maker that you're making a market for Bitcoin and you're making a market for I don't know like Litecoin, and then private and you're getting that money from private credit, and then there's issues in private credit, and the private credit lender says like, ah man, like we're gonna have to pull some of that money back. Like we don't want it. We don't want you to making that on Litecoin because it's a little bit risky for us. So they pull that money out of the market makers pull the liquidity out of the altcoin. They give it back to the private credit guy, and they continue making markets only for the larger cryptos. And the result is that liquidity begets liquidity. The more that market makers are market making for the larger cryptos, the more that liquidity goes there. And basically, I think that at a structural level, you basically saw a chronic shortage of liquidity in the altcoin space as a result of issues in private credit, where these private credit lenders were like, we're not giving you anything to do anything with altcoins. And the result is that there was not enough liquidity going in. That made it harder for new liquidity to come in, so it never did. And then you saw that concentration, continue to go into Bitcoin. And now you're starting to see it bleed over. The interesting thing, Nasib, is that if you look at the comparison of the current private credit crisis and then what happened in 2008, that the trigger for the crash was basically when banks started revealing how much of exposure they had to mortgage-backed securities in early 2008. And what's really fascinating is if you listen to banking experts like Chris Whalen, definitely check him out. He does a weekly show with Julia LaRoche. If you listen to actual banking experts, what they're concerned about is that like the large banks like JP Morgan, they're disclosing their private credit stuff because they're big, they do their stuff correctly, they don't mind. But all these other banks are not disclosing how much losses they had related to private credit. They're not disclosing because they have it in offshore entities somewhere that are not subject to U.S. regulation. So it's completely off the books. So what Chris Whalen is basically arguing is that, what he basically argues is that the private credit issue is much bigger than it seems, but it's not being disclosed because of the way that it's legally structured. And as a result of that, it's like they're just basically extending and pretending and hoping that eventually there's going to be enough of a surge of liquidity. And it's worth noting as well. Apologies for the tangent again, to see, but this is, in my opinion, very important. What happened in 2008 is that over the summer of 2007, that was when you initially started to see issues in mortgage-backed securities, and the Federal Reserve responded with emergency stimulus. But the thing is that the stimulus was not enough, and the issues continued. So that the second time when the bank started revealing these losses, then the central bank had to step in with even more stimulus. But the markets were basically like, oh, but you already did stimulus once before and it didn't fix it. So how can we know that the next round of stimulus is going to do it? And what I've been kind of thinking and wondering is, have we already seen that first wave of like that stimulus when the Fed started doing a little bit of bond buybacks, or it did not QE, managing liquidity, whatever it was, starting I think in December of last year? Was that kind of the kind of subtle way of trying to, they're like, okay, like we can see that liquidity is needed in private credit, so we're going to give a little bit out there and hope that it's enough. But if it's not enough, and then they go and do it again, then the markets are still going to fall because they're going to say, "Look, you provided liquidity once before; it didn't fix the problem. How can we know that now that you're providing liquidity again, that it's going to do it?" That's what happened in 2008. I think we're going to see a repeat of that similar situation, and the result is that you get a massive surge in stimulus to try and like basically restore confidence in the markets and in the Fed's ability, basically the credibility. So anyway, that's a bit of a long answer there, but it's really interesting. Yeah.
Yeah, it is. And when banks like JP Morgan and Goldman Sachs start building credit default swap indexes on private credit, are they hedging risk or simply positioning for the next big short?
So I'll be honest, but I'm not that familiar with what JP Morgan and Goldman Sachs are doing with credit default swaps. But whether they're like positioning for a big short or anything like that. But I would say based on what I've heard, it sounds like they're just hedging risk. And I don't know, in terms of who's betting against private credit. You can make the argument that it's still not big enough to be as systemic as but the problem is that it's so opaque that you don't know. But many people argue that because they basically say that private credit's not big enough to be a systemic issue. So the idea that JP Morgan and these entities would be preparing for some kind of big short, it's almost like it's too soon. It's not big enough to have to be a big short. You know what I mean? So that's kind of what, at least what I've heard. But this is what the private credit guys are saying, right? They're saying, oh, it's not a risk. Yeah, there's some misperformance here, but it's smaller than mortgage-backed securities were. It's more contained and blah blah blah. And insofar as that's true, then there's I think that whatever JP Morgan and these banks are doing is just hedging. But if it does become apparent, that there's some issue, and again, like if JP Morgan was shorting, I would imagine that Jamie Dimon would probably not be allowed to come out and say, "Hey, there's all these cockroaches and whatever," right? Like logically, that would be, I believe, that would probably be something that is against. You're almost like trying to manipulate the market, right?
As for the closing question, where is the best place for listeners to follow your work?
For now, you can just find me on X at Dan Macro with the zero instead of an O at the end. Yeah. So, but I mean, on there, I mostly just do like a repost of stuff. I'm not doing too much analysis yet. Hopefully, that'll change in the coming weeks. But yeah, that's where you can find me, and it's just like a stream of like retweets of like interesting stuff, and you can put the puzzle pieces together yourself. Yeah.
100%. Then thank you for joining me today.
Yeah. Thanks for having
And
me, man.
100%. And to everyone listening or watching, like, subscribe, or follow both of us, and share this episode with someone curious.